Welcome, everyone, to another exciting episode of the YouTube show and podcast, None of Our Businesses, where we talk about the news and weekly events, be it business, taxes, finance, or maybe none of those things. But what it always is things discussed from the perspective of accountants. In fact, 3 accountants today. I'm Ty Carr, and with me is Tammy Hess.
Hi, everyone.
And Charlie Zygmunt.
Hi, everybody.
What are we going to talk about today? Well, a 33-year-old employee of the accounting firm EY has died. There's a suspected suicide from overworking. We're going to get into this. Then we're going to talk about T-Mobile. Did they cross the line in ads criticizing AT&T's senior discounts? I want to talk a little bit about the Inflation Reduction Act and specifically the effect on accounting policy with regard to a 15% minimum tax on book income. Then we're going to talk about, again, the accounting firm EY in the news, splitting their audit and consulting practices. And finally, we're going to finish with the idea of making your commute productive. All right, well, let's kick it over to Charlie to get started.
All right, I've got an article we can start off with today from news.com called Inside Dark Work Culture, where 33-year-old died. And so what's going on is basically there's been claims of overwork at a Big Four financial services firm. Specifically Ernst & Young is the name of it. And he's a young employee found dead at work. Basically, they suspect it was a suicide. They said that she was found at the firm's offices, so it's something that happened at the office. Basically, she was found just after midnight last Saturday. The woman's identity hasn't been released, so it's not really so much about that, but it's more about just kind of what the work culture is. They said that kind of before her death, she had just gotten done going to a EY social function at the Ivy Bar and nightclub from 5:30 p.m. after having presumably worked up until then. And then after finishing a 2-hour party there, she went back to the office to go ahead and do some more work, is what it seems like. And so, they talked to some people related to the case and got some quotes. And one of the ones that they said is that working for the Big Four can feel like you're working in a sweatshop because they don't care about your well-being. They just care about output, output, output. And so, when pushed for questions on it, there was a managing partner of assurance named Matt Graham, who basically said that his records from the financial services firm placed the average hours worked per week between 40 and 42 hours. So he's basically asserting that people who work here are working normal hours. And, he goes on to say that includes the peaks, the time off, and all of that. And I haven't worked in a Big Four firm, so I don't know that I can speak as well to this as you both can. But for me, it's just like when I hear people talking about working in Big Four, the sentiment that I get from them is definitely not that they're working 40 to 42 hours. It's a number a lot larger than that. There was like another interesting thing in here where it says that the Hong Kong arm of Ernst & Young came under fire after a leaked email reported that employers were told by one manager to work from 9:30 a.m. to 11:30 p.m. as well as on weekends. And he went on to say, I think midnight is common in peak seasons. It counts on the discipline and responsibility of yourself. And so he's just kind of like buffing these people up to do this thing. But, to me, it's like, I don't believe those numbers. I'll see what you guys think, but I just feel like that. I feel like that is an average taken from a disproportionate, he basically cherry picked the data to find that answer, in my opinion. I can't prove it, but it's just how it feels. And so I guess just thinking out loud about it, what is the answer here? Is this an inherent change needed in the profession maybe, or is there some change that in the law that should stop this from happening, or do these kind of things just happen in all sorts of industries and this is just another example of that happening? What do you guys think?
So yeah, I think that it's interesting. I agree with you in terms of the math doesn't seem to work out right. From my experience and from what I've heard, I think that I'm not sure you can make any calculation kind of prove your storyline on that. But I think from my perspective, what's more disappointing about this is rather than I think there EY and probably other CPA firms are coming in as in the defensive versus like, let's think about this in terms of how do we help the situation? Because at the end of the day, the accounting profession and busy season that's tied to accounting profession is known to have a ton of hours, a ton of stress. The people who are coming, out of college, working all hours of the day into the night, and weekends and all that kind of stuff, it is very stressful. And even though I've been not in a CPA firm for in terms of for audit or taxes for many years, but we're not saving lives. However, when you're early in your career and you're working on a SEC publicly traded client and you're doing all this stuff, it does feel really like very crucial and critical, and you're overwhelmed and stressed. And so I think that what I would encourage the firms to do is think about ways to help combat that, in terms of providing, relaxation days, or, some type of system or way for folks to talk about it and to address it and to find ways to work around it, because it just seems like it's not surprising, and that's sad. It's not surprising that this could happen. And if, I'm sure they'll find out more about exactly what this particular person went through. But if it is because of stress and because of hours and going, working into midnight and going to a bar and then coming back to do work, it seems that is very not safe for folks in a working environment. And to be honest, you're not doing your best work anyways. I mean, when you're working that amount of hours and you're under that amount of pressure and stress, I would argue to say that you're not providing your best service to the clients either. So I think that kind of a reforming or reshaping of that practice and the commitment that it takes should be really what we should be discussing. So that's my point of view. What do you think, Ty?
Yeah, I think this particular case came out of it was in a foreign jurisdiction, right? Wasn't it? It was Australia. Yeah. Not that this couldn't happen in the US. I think that, but my overall perspective is that, and I feel this way, this kind of thing happens across a lot of things where there is a serious problem. And in this case, I think the problem is multidimensional, and some of the people involved in the problem and some of the outside observers, they know there's a problem, but they don't actually know what the cause of it is. And I think that we often jump to like easy answers to what that problem is, what the cause is. And so, if the problem is that staff at Big Four firms are highly stressed and do not, and suffer and may suffer from mental health challenges, or may have their mental health kind of challenged and cause them to suffer, I should say. If that's the problem, then I would say that the diagnosis that it's the result of firms trying to work their people for way too many hours is a possible cause of the problem. But my perspective is it's probably not the only or the unique cause of the problem, that there's multifacets to this problem with many different causes, and that sounds like a plausible cause of it, but I don't think that's necessarily by itself the cause. And I only say that because of my anecdotal experience working with multiple accounting firms, both large and small, having worked with the Big Four, and also talking to people, having my colleagues throughout my career who have worked at Big Fours, and then also talking to people who've worked within the same Big Four that I worked at, Big Four accounting firm, in different cities. And so one of the perspectives that I would throw out there is that I think that these issues of work-life balance within accounting firms are highly geographical dependent, and not as firm dependent as you might think. So when I worked at a Big Four in Portland, Oregon, in the Pacific Northwest, where I think in general we have a little more laid back work culture, and that's been that way for decades, compared to places like New York or the Bay Area in California or Chicago. I know that the average hours and commitment that was required or that was being given by me and my colleagues at a Big Four in Portland, Oregon was not the same as what you would see in New York, London, Hong Kong, perhaps this area of Australia or other places. And I also don't think it's necessarily firm dependent in that way, because having worked in local firms, worked with local firms, and then having worked at the Big Four, and I was in the tax area, which is different than audit as well. And I think every individual's experience is somewhat different too, but my experience was exactly the opposite in the sense of comparing firms. When you think about, when you want to label firms or people want to label certain firms as sweatshops, my observation is that there are a lot more small and regional firms that operate as sweatshops than Big Four firms. And one of the reasons and again, now I'm doing what I accuse the rest of the public do, is I'm attributing a reason to a problem that I see. I see an observation that sometimes the small and regional firms are more sweatshop-y than the Big Four firms, and I've attributed that. Maybe my theory's not right, but I've attributed that to the fact that a lot of times small and regional firms are trying to go after large clients, and they're trying to establish brand presence. And so they don't have as much market power. I mean, just to say it frankly, when I worked in a Big Four firm and I was managing engagements, I had a certain amount of brand and market power to push back on clients with unreasonable demands that I did not have and that I didn't see exercised by local and regional firms. So I think that local and regional firms sometimes are more susceptible to meeting unreasonable client demands than Big Four firms are in some regard. But again, it's relative. Like if I was working in a larger market where the money that we were getting from a big client was much more important to the firm nationally, then we probably would have been less likely to exercise brand power to maintain life balance for our teams, because the overall engagement I might have been working on would have been just so much more important to the firm. I mean, that's another dynamic of it. It's like in Portland, Oregon, for most of the Big Four firms, most of the engagements that you're on are not actually the most significant engagements for that firm nationally, or they're just one part of a national engagement that Portland, Oregon is just not a big market. And that I think also changes. That's what I was getting at with the geography of it. That also changes. So those are all some observations on the hours side. I think about whether hours at Big Four relative to other accounting firms, but it doesn't have to be a relative question. I mean, it could be, does our profession, whether it's a regional, local, or Big Four firm, overwork people or create or cause mental health challenges with people by just overworking them and overstressing them out? And I think, and my perspective is that we do stress people out, but I think it's because most firms, including my observation of Big Four firms, are poorly managed. Most accounting firms are poorly managed. And I don't think it's as simple as just saying, well, we just expect too many hours out of people. I think the reality is that nobody wants to admit, because I say nobody wants to admit it, but nobody says this as much publicly, because I think most of the time it's easier to be on the side of the poor staff accountants who are working so many hours. And certainly my heart feels for them too. But I also think that we're treating this as if all staff accountants are equally capable. And that's not true in my experience. That the reality is, and here's another point about talking about local and regional firms versus national firms. The other thing that obscures this issue is that the large national firms make this case that they recruit the best and the brightest. But I would suggest that there is a simple data point here from my perspective that must make that not true entirely. And that is that they hire en masse many more people than than the local and regional firms. So during years, and not every year is like this from a recruiting standpoint, and again, not every market's like this, but in the large markets and during years where they're recruiting large armies of people, the numbers, want to talk about suspicious numbers. Given the number of people that they hire out of school, to suggest that all the people that they're hiring are the best and the brightest doesn't make sense either. And so when you and what I and challenging that the firms aren't necessarily getting the best and the brightest, what I'm getting at there is that the actual aptitude and capability of the people working at firms varies. So if you give two different staff accountants the same amount of work, one may actually be able to do that same workload in 40 hours or less a week, and one may have to take 50 to 60 hours to do that workload, or may spend 60 hours at it and still not be able to get it done in the week. That's my experience looking at colleagues as I was a staff accountant growing up in the system, and being a manager who managed staff accountants and later a partner who managed people, is that we can't assume that, I think that's the problem with accounting firms, is that we try to put everyone in the same box throughout their careers. And that's just not the way it actually plays out in real life. And that's what I mean about I think the source of this stress and what we're talking about here is really bad management, in the sense that I think one of the comments that was discussed here was that the firms aren't treating people like individuals. They're just treating them like they're squeezing hours out of them. The part of that rings true to me is that we don't treat people like individuals, but I don't think it's as simple as we're just trying to squeeze the hours out of them. I think it's that the firms are so poorly managed that we typically aren't evaluating whether on a daily basis whether somebody is capable of doing the work that we're giving them. So we give them work that we think, because maybe we think could be done in a 40-hour work week, and that person isn't really capable of doing it in 40 hours. And if we cared to put some energy into treating them like an individual and understanding who they were and what their skills were and managing all the people on our team that way, we would know that, and we would adjust what it is we're trying to get them to do to cover for to deal with that issue, and to not stress them out so much that they might have thoughts of harming themselves, or otherwise be totally demoralized. And that's where, on the favor of smaller firms, I've seen some smaller firms that do that well, because they are smaller and they do care about their people, and they pay attention to what their people are actually capable of doing, and they don't and they set their expectations on an individualized level. But that's what I would say. Large firms, my experience on that's negative, is that they don't do that. That is the thing that they don't do, is they don't set individualized expectations. They set an expectation that is considered what it should be across the board. And so when there's people who can't handle those kind of expectations, there's no adjustment being made for that. In my experience at the partner level, it's not clear that they even know that. They don't realize, and this goes back to one of our colleagues, Brian Quo, posted on LinkedIn about this story that we're talking about. And he talked about people eating hours and how the metrics are all misleading. And I think that's true too. And that plays into this whole story that I'm saying, is that leadership has no idea who on their team is struggling, because people are skewing the metrics in order to fit in. But I think what Brian suggested, which I respect his opinion on this, and you can look Brian Quo up on LinkedIn and look at his post on this. What Brian suggested on this, and I respect his opinion on this, but I don't fully agree with it, is that he suggested that this then comes down to all the metrics are therefore just wrong, that the expectations are inherently wrong because nobody actually meets any of those expectations, because it's all just one big farce. And I think that's kind of the cynical view that you hear out there a lot. But I don't think that's actually true in every case. I think the truth is that is that there are definitely some jobs and some expectations and sometimes where they're just a complete farce. But I also think there are many where the expectations are possible for certain best and brightest and highly talented people, but probably not possible or probable for the average staff accountant, or certainly not possible for every staff accountant. And that's where poor management kicks in and the firms are failing, because that's where, again, I double back to, we're not treating people as individuals and figuring out what's actually possible for them given where they are and their skills and their abilities. So that's my very long perspective on this.
Yeah. Well, the thing that I liked about your very long perspective is and what I resonated with was the treating people like individuals and the management of the from leadership, because I think at the end of the day, not everyone can do or nor wants to nor is capable to do a lot of the various different things. And I also think their responses to such things can be different than other people. And so, I'm looking at if leadership was taking the time to better manage and look at what the numbers or what the hours or whatever it could be, what their people are feeling and experiencing, they would have a better sense of preventing something like this from occurring. Because I will say that this is not solely on the public accounting industry. I think there was a story maybe a few years ago, or maybe many years ago, about in the tech world of people working way too many hours and then forgetting, that they had a child in a car, and then they were working off of being sleep deprived and not making good decisions, right? So I think what I would say is that, well, a lot of times when people are reporting hours, it could be one or two things. One, the more hours you have, the better worker you are, the more you're contributing to a firm or to a company or to an organization. Or sometimes it's seen as the more hours you report, the less effective you are, you're not doing as well. And so there could be skewing of the numbers on either way. But I think what management leadership folks should be looking at and really working with is, what are their team doing? What are they experiencing? What are the true hours? What are the guardrails that need to maybe be put in place, or the check-ins that just need to be put in place to ensure that you're not overworking somebody? And because to Ty's point, it's not just about the hours. I don't think it's a lot of other factors that could be playing into that. It could be the pressure of meeting expectations. It could be the realizing that you're not the brightest and the smartest, and then you don't know how to handle that. And so you're trying to navigate against that. There's a lot of various different things that could be occurring that I think that leadership and management need to think about and really focus on, rather than doing the math of saying, here's why it's not true, right? So let's kind of forget the data point and let's look at, there is a problem. I mean, there's something that needs to be addressed and kind of viewed on.
Yeah.
Sorry, go ahead.
Well, I just wanted to throw in a different way to summarize, or an analogy to summarize kind of what I was saying, and it came from listening to some of what Tammy was saying there, is that, look, if you're a leader in a firm and you're gonna run a firm with the intent that it's all made up of Mensa members, and and that's true or whatever, then fine. But I would say you have a moral obligation, if you're going to set the standards and the expectations that all of your people are all members of Mensa, you have a moral obligation to ensure that's actually true before you abuse, because I think that's what this is about. We're psychologically abusing people en masse, holding them to high expectations that are not realistic for the everyday person that we actually have in our businesses, and so I think you have two ways to go at this. You either ensure you take the moral responsibility and you ensure that the people that you actually are working with actually can meet those expectations, which is a hard road to go, because let's face it, that would mean that you would have a small group that you could actually recruit and have in your business, right? Whether it's a technology firm or an accounting firm or whatever, right? Or you accept that not everybody in your organization is a Mensa member, and you set expectations that are more reasonable for the everyday person. Now I'm simplifying it, but I think that's the message that I would put out there for various leadership, is that it's morally irresponsible, and it causes this kind of abusive behavior to objectively be recruiting a group of people who obviously are not all Mensa members, and then trying to hold them to that kind of standard. That's ridiculous.
I agree with that point completely. And I want to take it one more level. Not everyone is cut out to be an accountant. Even some of those who get the job and who get far into it and make it into the big four and they pass their degree and they get the CPA and they do whatever they do. And they get to the end and they're dealing with stress and it just doesn't, maybe they don't have what it takes to be able to deal with a high level of stress, and that affects their psyche, and they do something out of the ordinary as a result of that. And we can look at that and say, how do we change the manager? How do we change the workload? How do we change the job? And all these things are true and possible that those are part of the problem. But it's also possible that this person just wasn't ready for the amount of stress that they took on. And I don't mean this individual. I mean anyone who's ever felt overwhelmed in a given job that they do. You could ask, how do we change the job to make it less overwhelming? Or you could say, maybe you're not cut out for this job. And in a lot of professions, this same thought process, like it feels really discriminatory for a second, because you're saying, well, if you're not ready for it, you can't do it. And so therefore we're discriminating against some portion of the population. But it's like, think about this. I'm a short guy. If I got put on the Trailblazers and had to play basketball, I'd come home and lose every night and feel sad about it. And I maybe want to off myself because I'm not a great Trailblazer. And we could beat ourselves up all day about the sport of basketball and about how the coach didn't give me the right level of work and so on and so forth. But we could also say, at the end of the day, each job that you want to do has a required set of characteristics. Might be physical attributes, might be mental attributes, might be how you handle stress. And these are high-paying jobs that we're talking about, being in the big four in Sydney, Australia. So if it ends up being the case that not every individual can handle that workload, part of the answer is, okay, then not everybody's ready for that scale of pay, really. Not everybody's ready to take on that challenge. And that's okay. That's okay. That just means that person has a role in understanding where they fit in, and they have a role in admitting when they're overwhelmed and potentially getting out of that industry prior to something that they can't take back.
Yeah, the only thing I would challenge on that thought, though, is I would say, if we're talking about the first year, second year public accounting person that's going into it, and I mean their pay is not great. I mean, it's not bad, but it's not like they're getting paid a ton of money to do what they're doing. And I would say too to that is that the stress level that they're feeling, it actually isn't equatable to what they're actually doing. And I think that that's part of the challenge is if the expectations were actually set correctly and communicated to the right out of college student of what they're going to be doing and what is the appropriate level of stress, I think that would be helpful in that sense. Because I would say, and I only know this from experiencing my first busy season of the things that I was really stressed out about and losing sleep over, in terms of just, oh my goodness, it's my first job in the real world, it's all these kind of things. It didn't matter if I could reconcile cash in 4 hours versus 4.5 hours. None of that was really, I was bringing undue stress upon myself, just being stressed out because everybody else was stressed out, and so it really is kind of thinking through what is the job at hand, and let's be realistic, and let's set realistic expectation and give the avenue or the environment to talk about, oh wow, am I doing this right? Am I focused on the right thing? Am I doing enough hours? Or am I doing too many hours? I think it's setting the environment to have that so you can determine whether or not you're cut out for it, because I don't think you don't know when you're in it, because you really are working in kind of like a bubble or a vacuum. I'm not sure which one, but you really don't know. And so you're just assuming, and you're making all these kind of assumptions from the person from both sides, probably at this point. And so you're just running amok, and then it does become too much. And so it is, I think I would just stress on both sides of just understanding what the environment is.
Oh, I agree completely. All right. Do you have another article we can talk about, Tammy?
I do. So on a completely different topic, many of us have seen cell phone ads that talk about how they are better than their competitors. They often provide statistics or maps or other claims to show you how they are better. And some companies may even go as far as to name its competitor within their ads. Well, T-Mobile may have taken it a bit too far with its new ad campaign. According to Yahoo Finance, AT&T recently filed suit against T-Mobile on their recent campaign, stating that T-Mobile's claims are inaccurate and not true. So T-Mobile's new ads are targeting the senior citizens demographic and has been dubbed Verizon and AT&T banned senior discount. So what T-Mobile is saying is that 92% of seniors in the US can't get a wireless discount from Verizon or AT&T because they don't live in Florida. The focus of the ad is meant to showcase T-Mobile's unlimited 55 plus plan, which provides a discount to those over 55 to access the T-Mobile network. It seems that AT&T also offers a discount to seniors. However, it's only available in Florida. T-Mobile has not commented on the suit yet, but the CEO of AT&T was quoted in saying that there is a demonstrable damage done in the market, given how broadly communicated this was to the senior community. So we're going to have to wait and see what will happen and what the courts will do about this suit, because it was just filed earlier this month. But I thought it raised the question, is it better to advertise in a way to showcase your product or service on its own merit, or by showcasing how you are better than your competitors? What do you guys think consumers prefer?
I think the consumer would prefer that to not make the test be relative to somebody else, because they're buying the product, and to them, the product is what the product is, regardless of what something else might. Now, they may look at your two products and say, okay, I still choose something over the one that you're showing. But in that example, you wouldn't care because they're choosing the one that's right for them, right? It's not up to you to change their mind per se, or to convince. It's not about if your product is better. It's about if your product is a good thing for them or not. And if they want to look at 10 different ads and choose from, the one that makes the most sense to them, given the claims of that product, not what they all say about the other ones, to me, that's very normal, and that's how it should be.
Well, I think yes. I mean, I guess my disagreement would be that may be how it should be, but I think negative ads work. I mean, we know that criticizing the alternative works. That's why political candidates do this in their advertising. I mean, the data's in that pointing out the defects of the alternative to you is an effective strategy to getting people to go with you in a variety of circumstances. So yeah, I mean, I do think I agree with Charlie's point that it is a better overall strategy to or strategy is the wrong word. It feels better overall to all participants, both the people who are sending the message and the people who are receiving it, to have some positive news and positive things to say about what you're going to do for customers and what features you have for customers, really promoting those and all that. I think that is better. And I guess what I don't know when I claim that negativity does work as well, I mean, if you have features that are so demonstrably advanced or better than the competitors, then maybe it does work to just focus on your obvious and better features. I think the problem with these telecommunication giants is that they're competing in a very kind of close market where the features are very similar across the board, and it is difficult to say that one provider is demonstrably better than the other, although I'm sure many of our listeners have their favorite and will say, oh, I insist that Sprint is better than any of them. Yeah, I mean, that's my thought. Negativity, unfortunately, the reason it's done is because it does kind of work.
Mm-hmm. Yeah, I think what I didn't really put two and two together was the fact that you're right. A lot of these cell phone providers are it is hard to differentiate between the two of them. And so not only do they need to do that, but then they do it by naming the other group so that you are willing to make the change. I think that though, what maybe T-Mobile can learn from this though, if you're going to throw out stats out there or any type of of claim that you are accurate or close to it, because getting having a lawsuit filed against you is not going to be pleasant to deal with. But I do think that it would be a better marketplace if it could just say, hey, here's my product, here's why it is better than the others, or here's why it's cooler than the others, or some type of spin to make people want to use that service or buy that product versus slamming the other competitors, especially if you can't slam them correctly and then you get sued. So something to kind of think about, I guess, going forward. We'll have to wait and see how it all turns out. Ty, you have our next article.
Yeah, and there's actually several articles about this. I'm going to point us to an article that I pulled from the Tax Advisor, and it's about what I wanted to talk about was the Inflation Reduction Act, which was passed just about a month ago now, and there's a lot of provisions in there, but specifically for our purposes and our audience, I wanted to talk about some of the tax provisions that would be of interest to accountants and to businesses that deal with the accounting. But a lot of it is really accountants of accounting interest of interest. The kind of the three main tax provisions that I think would be interesting to discuss here. So the article that I mentioned, the article that I pulled for looking at this was from the Tax Advisor, but if you just Google the Inflation Reduction Act, you'll get all kinds of different articles, Forbes and Market Watch and all the regular names out there, just to name a couple. But there's all kinds of articles out there about it. But we'll put a link to the Tax Advisor in there because it's easy to access. But in any case, I just want to kind of throw out the three pieces that are the three tax items that I think would be interesting for us to discuss here. One of them is the minimum corporate tax, which was designed to hit large companies. And so the minimum corporate tax kicks in if a company's average annual revenues is above $1 billion. And there's a way of measuring that I won't get into here. But in general, if you're punching in with annual revenues over $1 billion, you're a really big company on a worldwide basis here. And they have thrown in that your minimum tax, your corporate tax would be calculated in the same way it always has been, but on the side, there would be this calculation that takes 15% and multiplies it by your book income. And if that tax is more than the regular calculation, then that company then would owe the minimum tax, the 15% of book income. And let's bear in mind that the analysts who put this law together are kind of presuming that in most cases it would be more. and there's a good reason for that. And it's because that, while the U.S. C corporation tax rate statutorily appears to be 21%, there's all kinds of deductions and credits and various things that and differences between financial statement book income and taxable income that usually result in most of these companies paying an effective tax rate that's less than 15%. So 15% on their book income. And that's the reason why we would assume that the minimum tax most likely would kick in. And the thing about that is, when we talk about book income, what we're talking about is income as measured under financial accounting standards, rather than based on tax laws. So, I think that opens up some interesting accounting theoretical problems, or accounting cultural problems, perhaps how you want to see that. But I'll throw that out to the group. And maybe I said there would be three items. Let me mention there's a couple other items, but maybe let's just stick with this one item for today's discussion. So the other two items, just for people's interest, are that there's a 1% excise tax on corporate stock buybacks. And then there's also $80 billion of funding heading to the IRS for enforcement and other programs to improve their operations. But I guess what I'd suggest is, for today's podcast, maybe let's talk about the 15% minimum tax on book income, and then we can pick up the 1% excise tax and the funding going to the IRS in a later episode, if that sounds good to you all. I'd love to hear, Tammy and Charlie, what you think about the potential impact of the 15% tax on billion-dollar companies is.
Well, I mean, I feel both ways about it because on the one hand, and I think everybody else agrees that companies that have reached a certain scale should be paying a certain level of tax. Whether or not 15% is the right number is its own question. But so I agree that, yeah, once you get big, you should be paying something. Where I start to take issue with this, just from the standpoint of somebody who's been kind of dealing with the numbers of businesses for a long time, is that any tax that punishes a business for having a very low margin by basically making a volume play to have a lot of sales and break even on a lot of sales. If you just think about the idea of a producer who decides to add break even sales to his mix, right? So he's selling all this stuff, making money, great. Somebody comes to him with another order and says, okay, we're going to order a bunch of extra things. And the only way you can really get this deal is to come really close to break even on it, right? So you're going to spend the same amount of money that you're going to get out of it. And it might make sense to you for different reasons, right? Maybe you're trying to reach a scale, you're trying to reach some kind of level of how you're doing, but you're really not making any money on that deal. And so in that very specific example, you would end up paying a bunch of tax, even though you functionally did nothing. And I don't think that's the goal of the people, when the people are writing this law. I think their goal is get big companies to pay some tax. That's the goal. But get people who are breaking even on sales to give us a chunk of that break even sale. I think that's an unintended consequence of the law. And I think they somewhat solve it by saying, well, we're going to only apply this to $1 billion companies. So those issues don't really apply at that scale. But, maybe I'm a skeptic. I don't know that I agree. I think break-even deals can happen at any level of business. And I think it's just more complicated than picking a flat tax rate. But I'm glad something's being done. And I think we can start with this, see how it goes, and then adjust because, the entire corporate tax system has been changing, for many, many years. And so this is just another thing to try, I think. What do you think, Timmy?
Yeah, I think what you said is correct in terms of, I don't think the goal was to penalize folks that are doing the break even deals or to get some type of funds from that. But I think and I might be speculating here, but I think the goal is the fact that a lot of times these larger companies have a lot of workarounds where they aren't paying probably any tax or very minimal tax or whatever it is. And so how do you get to where you are a successful large company and to pay your an adequate, maybe I should say, I don't want to say fair because there's nothing fair probably in taxes or people might say, but that's adequate to what their size is. And so I don't know if this is the right answer per se, but I think it is kind of a step towards that kind of conversation of how do you ensure that companies are paying their fair share of tax. And so I don't know if there's more to that on your perspective, Ty, but that's kind of where I'm kind of sitting at right now.
Well, I guess what I would ask the two of you to weigh in on is, how do you feel about basing the tax? I mean, the rate, how do you feel about basing the tax on financial book income?
I think a lot of the things that change book income from tax income are designed to give the reader a more accurate picture of how the company is doing. And while it's not always a measure of reality, so I realize you can end up with book income when you don't have the cash to support it by having receivables, for example. So sometimes it's not the best measure of reality, but I think that because the intent of the changes, when you look at what changes from tax income to book income, all those changes have one thing in common. They're intended to help give the reader a better view of what's really happening. And so to me, if that's true, basing our tax off book income is not a problem from that perspective, because again, those are the things we're doing to try to get a better view of what's happening. Mm-hmm. So keying into it with our taxes seems somewhat logical. I get why it's not now, but I could see why you would want to key into that.
Yeah. But I think most operators and most people do probably relate more with the book with book income than they do tax income. And when, because I always, whenever anyone's like talking about and thinking about taxes versus their financial statements that they actually have in house, a lot of them are looking at their, actually, I'll say it differently. A lot of people are using their financial income or statements, their book statements for analysis and decision making, right? So it does make sense that you tie that into the tax calculation because it is what makes sense to people versus kind of the little ins and outs on the tax side that, you know, I don't always understand, but I could say most business operators don't always understand that, and that's why they need to have a tax professional in the house to kind of explain the rules and the calculations of the way things work or don't work.
Yeah, I think that's I think that's right on in the sense that conceptually speaking, from an accountant's point of view, book income is the real income versus taxable income, which is this kind of made up thing that is the result of, but I think that's the rub. It's like, okay, well, if there's this thing in the accounting world of book income, which is your real income, and we accept this idea that your taxable income is not that, you know, why is it that taxable income is any different than book income to begin with? Why was it different, right?
Yeah, why? I mean, that's the age-old question, I guess, in terms of it made it more complex and more complicated than it probably needed to be. Because then what are you trying to measure and perform against?
So the political question then is, then are the same forces that ultimately led to taxable income not being real going to ultimately affect the calculation of book income now?
It seems like it would be, you know. Yeah, I mean, I think it depends on when I think about it, it's like which one makes more sense. You know, let's look at like some quick examples. So like if we're looking at somebody who has receivables that they have not collected, and then they're asked to pay a bunch of tax based on those receivables because it's accrual and that counts. And let's say they don't get paid on those receivables. You know, I know you have allowances for bad debt and whatnot, but let's just say your allowance wasn't accurate for what ended up happening. So in that very specific example, I think it kind of makes sense that that guy shouldn't have to pay the tax based on his book net income because he doesn't have the money. The book net income is fake. He never collected it.
But in that example, Charlie, that would be adjusted in the next time they look at the receivables, right? So maybe it's not adjusted in 2021, for example, but if you deem that account to be uncollectible, it could be.
If he makes it to year two, if the taxes of year one were so terrible that they put him out of business, and then in year two, sure, it all rights itself, but by that point he's shut down, so it becomes irrelevant. I know I'm making an example that's intentionally ridiculous, but
it's a good example, but because then I would tell you that owner should do a better job of evaluating their allowance for doubtful accounts so that they would not be put in that position.
That's true.
Well, and then, you know, taking this back into the kind of social implications of taxing book income, it seems like in that example, then this puts a lot more pressure on financial statement auditors because the incentives now we've got entirely different incentives on this question, right? Like the incentives so far may have been, you know, these $1 billion companies are public companies, right? So the incentives have always been in mostly one directional in the sense of, you know, how do we skew our numbers so that the company looks better financially? How do we skew our numbers so that the company looks more profitable for the purpose of, because we're a public company, for the purpose of the markets? But now we've got an alternative. Now we have now these $1 billion companies have a whole different alternative incentive structure in play, right? How do we maybe minimize income or minimize profit in this particular period because of the tax that may be levied on us due to it, right? And it also leads to, I mean, maybe those two things counterbalance this out, but wow, what an interesting academic question, right? So from a social science perspective, which of the two incentives is going to win out now in the market? The incentive to inflate income for the purpose of public company filings and stock valuation, or the incentive to deflate income for the purpose of minimizing taxes? Which is the more powerful incentive? Are they actually equal? I think there's a ton of potential research that can be done there.
I think it's really interesting, and it might be individualized. It might be that in one company it makes total sense to abuse income to get your taxes down. Another company's trying to grow, they're trying to get capital, they want book income to look high so they can get as much cash as they can. And so I think it is a really interesting question.
Right. All right. Well, I've played with that enough. Let me kick it back over to you, Charlie.
Cool. All right. Yeah. I think this is I got another article that I think fits really well into what we're talking about. It's from Morning Brew and it's called EY plans to split into two separate businesses. And so the reason I think it kind of goes hand in hand is we're talking about, what they're doing is they're taking the two parts of their firm, which is auditing and consulting advisory, and they're basically splitting them into two separate entities. And one of the kind of conceptual thoughts as to why they would want to do this is because the article talks about it as it's kind of like having football players and referees on the same kind of team, right? Because you've got somebody handling the numbers, making the decisions, giving advice, and then you got another person who's supposed to be objective third party reporting on what's happening. And it just, it creates this conflict of interest. And so this high stakes move is, according to the article, intended to juice the consulting practice of Ernst & Young by removing all of the conflict of interest from the equation. And so it's going to be extremely time consuming because it requires approval from the firm's 13,000 partners across 140 countries. And the article mentions not to mention figuring out who gets the E and who gets the Y. And so, which I thought was, beside the point. But and then it says, this is one of my favorite lines from the article, partners might be too busy browsing for thoroughbreds to weigh in. Why would that be? Well, following a public listing of the consulting company, auditing partners could receive a cash payout equivalent to 2 to 4 times their annual pay, which averages $850,000 to $900,000 per year. So the article's premise is that these people aren't even going to get their approvals done because they're going to be so rich from this payout that they're out there gambling on horses. And so, we'll see if that's how it plays out. But the other three, this is what I thought was interesting. The other three of the big four firms, so we're talking Deloitte, KPMG, and PricewaterhouseCoopers, say that they don't plan to create a gap, which the article used GAAP, but they don't want to create a gap in their business like Ernst Young. Instead, they're hoping to capitalize on Ernst Young's restructuring plan to plunder talent. And so this brings me to kind of what I want to get you guys' opinion on is this core question of is it true, getting rid of conflict of interest is designed to grease the wheels, right? If that's true, and Ernst & Young has come to that conclusion, why aren't the other firms doing that, right? Because that seems like a very core question that would apply to all of them. And so I just want to get you guys' take on why would that be?
I think it's basically how they decide to manage it, because let's be kind of transparent here. When a firm does auditing and it also does advisory, it's separate. Like they make sure the separate partners are involved, it's separate teammates, it's all this kind of stuff. They make sure that they don't have a conflict of interest in the audit, especially on the audit side, in that. And so they put in all these guardrails and barriers so that it doesn't happen. I think taking that out and just splitting up the company makes that you don't have to do all those rules and regulations in that way, right? You don't need to have the guardrails set in place because it's two different companies and with different partners just by the nature of it. It's like you're really setting the infrastructure so that it is completely avoided of any conflict of interest. So I think that's probably why, I guess my answer is why the other firms aren't doing it. The systems they have in place to already prevent the conflict of interest is good enough, and they're willing to work around it, and they don't see the need to do that, or to what the article stated at the beginning, that it takes so much time to unwind and separate that they don't want to take that effort. And so as long as they have the controls in place to make sure that they are avoiding such and keeping those lines of business separate, why change? But that's just, that's kind of my first initial thought. How about you, Ty?
I think, I guess I doubt that the payout or the expected value of the consulting practice, that there's a huge premium. I think they're probably overstating the case in terms of the premium that's in there that is a result of being separated from the audit firm and therefore kind of having the cuffs taken off and they can do more projects that are more high value kind of thing, right? I mean, that's the proposition they're trying to sell is, oh, if we separate from the audit firm, the consulting practice can do even more for clients than they have been, and that's going to make them so much more profitable, and that's creating a premium in the presumed value of this new consulting practice, which part of that is going back to the audit partners who basically are selling off that part of the practice to the remainder, to the consultants who will take it on from there. So, I mean, that sounds theoretically possible, but I suspect that this move is preemptive in the sense that, and I think it better explains the question, why are the other firms not doing this, is because I think that premium is being overstated from a marketing standpoint, and that this move is actually just more preemptive because E&Y has been on the ropes for audit failures in the last few years. I forget the names of them, but if you look it up, there's been several audit failures that E&Y has been at the center of. And we've seen this story before, that when there's audit failures or otherwise scrutiny on the audit industry and this marriage that firms will have between auditing and consulting, the go-to move of the big four firms is to divest of their consulting arms temporarily. And that staves off regulatory mandates, which then allows them to go back and rebuild consulting arms later, because there are no like actual hardcore official rules that prevent them from doing that. And this has happened in the past in the US where big four firms have divested from their consulting firms, and then years later, suddenly they're doing consulting again. So it's, the reality is that the firms build relationships through their audit practices. They have a franchise on large companies because there's only so many firms in the world that can do large public company audits because of the capacity and the human resources that it takes to do those audits. It basically makes it so that there's only a few qualified players that could do these audits. And that franchise then puts these audit firms in the boardrooms and in the executive meetings of large public companies and gives them unprecedented access and relationships that they can then build and later monetize. And so some firms are going to milk those relationships and monetize them through ongoing consulting work that they don't divest of, and others are going to sell off the value of those relationships by divesting or selling off their consulting practices occasionally, and then going back and rebuilding it. I would bet that 10 years from now, after this split happens, 10 years from now, E&Y, the audit firm, will have a consulting practice that they're considering whether they should divest of or continue operating.
Ty, do you think that this could be, because there are some SEC companies that will use one of the big four to do their audit, and then one of the big four to be their consulting, or use their consulting side of it? Do you think that why might they be thinking, hey, for those SEC firms that have permanently separated the two activities and bringing it outside of E&Y will now utilize either the E or the Y, and they can do both now again?
Yeah, I mean, I think certainly it allows them to leverage their relationships in a more flexible way. And so, that would be a contradiction to my belief that maybe this premium that they're talking about being able to split is not as big as they're making it sound. And you're making a case for, well, maybe it is. Maybe there is a pretty good premium there, and I can buy that.
Yeah.
It'd be interesting to find out. I mean, we'll all kind of keep our eyes on it, and we'll let you know here on the podcast how it goes. Do you have another article we can talk about, Tammy?
Yeah. So, as offices are opening back up, we may be finding ourselves spending more time in our cars, commuting back and forth to work. Accounting Today posted an article with some helpful tips in making your commute more productive. The article suggests including your commute time into your office hours time by calling clients, listening to audiobooks on professional development, or checking in with your team. While I would agree that making the most of your time during the day is wise, and I am a big fan of multitasking, I am not sure if these are the best ideas if you are actively driving. The article started with stating how commutes are often seen as stressful and awful, which can put you in a negative frame of mind for the rest of the day. This negative state of mind can impact your clients, teams, and family. The article suggests that by thinking of your commute as a quiet oasis of contemplative time for yourself, it could really, change the game. That I can agree with, but if you're driving in rush hour traffic, paying attention to the cars around you, I have a hard time thinking you should add business calls to the mix. Could that be seen as distracted driving or even counterintuitive to a quiet oasis? Are you going to give your full attention to the caller you are talking to? Alternatively, if you're using public transportation, should you be worried about what you might be talking about or if the background noises is distracting to the person on the other end? So I had a lot of thoughts or maybe more questions than I had answers, but I'm curious to what you guys think. Is it wise to incorporate work into your commute? Are there other ways to conduct business effectively while driving?
Yeah, I might be biased here, but I'm of the opinion that I think it's ridiculous. I think that when you're driving, you're driving. When you're working, you're working. You can't do either one effectively while you're doing the other. You might get away with it momentarily. So it could be the case that you're on a call, you're driving, and I accept that it can happen at the momentary level, but we're talking about it at a very like, should this be the case or not? And I think across a broad spectrum, it should not be the case because it's just too dangerous. And I'm not even this like traffic safety, personality or whatever, but it's just like, yeah, I know that my work takes focus. I know that driving takes focus. I can't give all of myself to either one. So why do that? And then finally, last thought on it is just that I'm kind of a weird opinion of commutes. Everybody looks at it as this stressful thing. To me, it's a very quiet time of the day where not a lot is happening, and it's a little bit of like a break when you have it. And so I guess that's all relative. It depends on what your office environment is like. It depends on what your home environment is like. But to me, commute should just be what it is. What do you think, Ty?
Yeah, I 100% agree with both sentiments that, if commuting means personally driving, then I don't think you should mix the two. But I've actually done this in the sense of I, you know, I've always for my career when I was younger and up until this point, my career has been a corporate type career where I knew up until, the last few years, I knew that I probably would be in some kind of office in a downtown area. If not, we're in the Portland metro area and there's a couple of different areas in our area that could mean. It doesn't necessarily mean downtown Portland, but in any case, I've intentionally always where I live has always been a consideration on the commute issue in order to minimize the commute. Um, but what I found later in my career is that it wasn't the time for me to go into a fixed office. I had an office at one point in downtown Portland, and it wasn't the time it took me to get into that office that was the killer. It was as I got later in my career, it was the fact that I was going around to multiple clients and all kinds of meetings in person in different locations throughout the town. And that's a lot of time, logistics time back and forth in cars and stuff like that can suck up a lot of time. And so what I started doing, and this was actually way before the pandemic, I mean, probably at least 2 years, if not 3 years before the pandemic, I started actually using Uber and Lyft and using those kinds of services. And I did the math and I realized, particularly when you're in a professional service environment and you bill your hours, it was obvious that I would, and if you weigh in gas, maintenance, and downtown parking, along with the fact that you can recover some time that you might otherwise have as billable time working by not driving yourself, but sitting in the back of another car and letting other people take you places, the math became obvious. But while the math became obvious to me, it's interesting that for me and many of my colleagues, like other people who are partners in accounting firms who the math should be similar to them, this was not an obvious thing to them to do. And I think that, the ride sharing economy changed the game because, this is not an old thing. I mean, in large markets, if you lived in bigger cities and large markets, lawyers and other professional service providers have had hired drivers forever to, instead of driving themselves, and gotten work done in the back of cars and stuff. But the idea, sitting here in the Pacific Northwest, culturally, that's not a norm to do, even if you're, a highly paid per hour partner in some big law firm. It's still not even that normal to do in our area. But I think it was worth reconsidering many years ago with Uber and Lyft availability. And I think it's probably still worth reconsidering now for those who have a lot of driving around in their job and they otherwise could be billable. And I would point out that, you might look at it and be like, well, I'm not going to whip my notebook computer out in the back of an Uber and actually do real work that's billable. Well, here's the thing, if you look at the list of some of those things that Tammy was talking about, if those are things that you would otherwise do during your day, and then it frees up, time is fungible to some extent, right? So it may not be that I literally work for a client in that minute or in that 20 to 30 minutes or even an hour that I'm in a car. Maybe I'm not working literally for a client and billing the client for that time, but I'm doing something else that I'd have to get done that day, whether it's administrative or some reading or whatever. And that should, in theory, free up that time to actually do work when I'm in a position to bill a client, right? So I think, for many of our listeners, who I presume a lot of them are accountants, I would consider this possibility. 100% agree. Don't do it while you're driving, but consider the options here that you might have for not being the one who's driving.
I would agree with that. I would say that taking a ride share completely changes the math of the equation. And so, I kind of skipped over that option as I was giving my answer, but I just want to say, if somebody else is driving, that really takes the danger element out of the equation and just, to me, makes a lot more sense.
I agree. I think that could have been more clearly defined in the article, because that is a great solution to some of that. And especially, I like the idea too, because maybe it's not you're taking a call in the Uber or using mass public transportation, but maybe you're reading, reviewing, you're doing something that it can be done, pretty quietly or kind of privately. And so you can do that while you're being taken from point A to point B. So, well, things for people to think about if they're going to, you have some options there.
All right, everybody, that's going to do it for the None of Our Businesses YouTube show and podcast. Please tune back in again next week for more business updates from an accountant's perspective. And please check out our sister podcast, Profitless on Purpose, where they're talking anything and everything relating to the nonprofit space. Thanks for joining, everybody. Bye.
Bye.
Bye.